Hey everyone, welcome back to We Are Cosmic, your go-to space where we break down the mysteries of cryptocurrency and global finance in a way that's simple, easy to understand, and actionable. If you've ever wondered how crypto really works behind the scenes and why some coins have the potential to completely change the financial system, you are in the right place. Today we are diving deep into XRP, the digital asset that's quietly reshaping global money movement. And yes, we're talking about numbers that most people call impossible. Let's start with a question. Have you ever heard someone say that $10,000 XRP is mathematically impossible? Most people assume this because they're thinking in the old way, 20th century math applied to a 21st century liquidity problem. But here's the thing. Trillions of dollars are sitting idle in bank vaults around the world, doing nothing, while the financial system struggles to move money across borders efficiently. That idle capital is basically dead weight, and that's exactly the problem XRP is designed to solve. You see, every time you send money internationally, it doesn't magically appear on the other side. Instead, it goes through a complex, outdated system of nostro and vostro accounts. Banks have to pre-fund accounts in foreign countries just to make sure your payment clears. Imagine billions of dollars just sitting there doing nothing. This system is slow, expensive, and frankly, stuck in the 1970s. Meanwhile, data can circle the globe in milliseconds. Money, not so much. Now here's where it gets exciting. XRP isn't just another cryptocurrency, it's designed to act as a bridge, a universal connector that allows banks and institutions to move money instantly without pre-funding. Think of it as replacing a clunky, outdated postal service with a high-speed express train. On-demand liquidity means the world's capital can move freely, and this is exactly why some people are starting to see XRP as the plumbing of the global financial system. But wait, there's more. You might have heard about RLUSD, a stablecoin designed to complement XRP. Some critics think it's replacing XRP, but that's not the case at all. RLUSD acts like a fuel line. It provides stability for institutions to prepare their money before sending it across the XRP bridge. XRP still does the heavy lifting. RLUSD just helps manage the timing and ensures that everything flows smoothly. Together, they form a closed-loop system that allows institutions to move billions without causing major market disruptions. So why does this matter to you as a crypto enthusiast or an investor? Because when you start understanding the mechanics, how XRP handles trillions in daily volume, how RLUSD provides the entry point for massive capital, and how the old banking system is being slowly bypassed, you begin to see why the price targets people laugh at might actually make sense. We're not talking hype, we're talking structural math, supply and demand, liquidity depth, and real-world adoption by banks and institutions. Before we move deeper, let me just remind you to hit the like button, subscribe to We Are Cosmic, and turn on notifications. This way, you won't miss any of our upcoming breakdowns where we'll dive into charts, real numbers, and step-by-step explanations of how XRP is quietly becoming a global bridge. Also, check out the pinned comment for resources like our Discord and free courses to stay safe and informed in the crypto space. All right, now that you're caught up and oriented, in the next part, we'll dig into the actual numbers behind XRP, the $27 trillion liquidity gap, and how XRP is positioned to pull this idle money back into the active economy. We'll break down the math, the visuals, and what it really means for the future of finance in 2026 and beyond. Stay tuned. This is where the story starts to get really interesting. When most people think about money moving across the globe, they imagine instant transfers, fast payments, and seamless banking. In reality, it's the exact opposite. Traditional banking is slow, expensive, and heavily dependent on pre-funded accounts in foreign countries. Banks have to keep massive piles of cash sitting idle, trillions of dollars, just to make sure payments go through. This isn't just a minor inconvenience, it's a huge drag on global growth. Money that could be working in the economy is stuck in a vault somewhere. Here's where XRP comes in. Unlike traditional systems, XRP acts as a universal bridge that moves value instantly without the need for pre-funding. Banks no longer have to lock billions in foreign accounts. Instead, they can use XRP to facilitate payments in real time. Imagine a company needing to pay $10 billion overseas. Under the old system, that would take hours, days, or even weeks with millions of dollars tied up along the way. With XRP, that transfer happens almost instantly, and the liquidity stays active in the global economy. This is why XRP is often called the plumbing of the financial system. It's the underlying structure that makes fast, efficient, and scalable money movement possible. Now, let's talk numbers. The global liquidity gap is estimated at around $27 trillion. That's the amount of money sitting idle across banks, waiting for cross-border friction to resolve. This is not some abstract figure. It represents real capital that could be deployed if a more efficient system were in place. XRP's bridge technology allows that money to flow back into the economy, creating opportunities for growth and efficiency that traditional banking has never been able to provide. On-demand liquidity, ODL, is the key here. Instead of banks pre-funding accounts in multiple countries, XRP provides the liquidity only when it is needed. It's like having a superhighway for money instead of forcing each car to wait in line for hours. The result? Transactions happen instantly, capital stays productive, and the overall economy benefits. This is why institutions and payment providers are increasingly turning to XRP. It's solving a $1 trillion problem that the old system simply cannot fix. To make this work for large institutions, XRP often works together with stablecoins like RLUSD. The stablecoin acts as a holding mechanism, ensuring the value is locked until the moment it needs to be transferred across the bridge. XRP then handles the heavy lifting, moving massive sums of money with almost zero friction. This combination creates a closed-loop system where money never leaves the ledger unnecessarily, reducing risks and making the process seamless. Another important point is the speed of settlement. Traditional banks might rely on systems that operate at the speed of a 1970s postal service, but XRP can move value in seconds. This isn't just faster, it's transformative. When trillions of dollars start moving efficiently, it changes the way institutions handle global payments. Banks can free up capital, reduce costs, and provide faster services to clients. This is why XRP's utility is often misunderstood. It's not about speculative trading, it's about creating the infrastructure for a new era of finance. In short, the $27 trillion liquidity gap represents a massive opportunity for XRP. Every dollar that moves through the XRP bridge isn't just a payment, it's a demonstration of real-world utility. The more institutions adopt this system, the more value flows through the network, increasing the depth of liquidity and reinforcing the system's stability. XRP becomes not just a coin, but a critical financial tool for a global economy that's ready to move beyond outdated banking methods. Now that we understand how XRP moves money and fills the $27 trillion liquidity gap, let's dive deeper into the role of RLUSD, the stablecoin designed to work alongside XRP. Many people think stablecoins are competitors to crypto like XRP, but in reality, RLUSD is a critical part of the system. It acts like a foundation, giving institutions a stable point to lock value before sending it across the XRP bridge. Think of it as the starting point of a pipeline, the secure fuel that ensures massive sums of money move smoothly without disrupting the market. Institutions don't just want to send money, they want to do it without causing sudden price swings. Imagine trying to move $10 billion in XRP at a low price. It would completely disrupt the market. RLUSD solves this by providing a stable store of value. Institutions can prepare their capital in RLUSD, wait for the right moment, and then transfer it through XRP's bridge with confidence. This creates a closed-loop system where the money never has to leave the ledger unnecessarily, reducing risk and friction. The pipeline looks something like this. Capital enters as RLUSD, waits for the optimal moment, and then XRP carries it across borders. Once the transfer is complete, the value can be converted back to RLUSD or another currency. This setup ensures that every cent stays within the system, maximizing efficiency. The combination of RLUSD and XRP allows institutions to move massive sums without touching traditional banking infrastructure. It's a two-pronged system where RLUSD stabilizes entry and exit points, and XRP handles the real-time settlement. One of the most exciting things about this setup is how it changes the dynamics of global finance. As more institutions use this pipeline, the liquidity on the XRP ledger grows, making it easier to handle larger trades. Deeper liquidity means less friction for big transactions, creating a system that scales naturally as adoption increases. Essentially, the more capital that flows through the network, the stronger and more stable it becomes. This is why XRP isn't just a speculative asset. It's a utility-driven infrastructure for the modern financial world. RLUSD also plays a role in risk management. By locking value in a stablecoin, institutions can wait for optimal conditions without worrying about price volatility. This allows them to plan large transactions carefully, avoiding the spikes and dips that typically occur when moving huge sums in traditional markets. The synergy between RLUSD and XRP creates a system that's predictable, scalable, and ready for institutional adoption. Another critical point is the pressure relief function. XRP handles the heavy lifting, but RLUSD absorbs the timing pressure. For example, if a bank wants to move $5 billion, it can mint that amount in RLUSD and then schedule the transfer through XRP when market conditions are ideal. This coordination minimizes risk and ensures the network can handle ultra-large settlements without disruptions. Institutional adoption is also creating a structural shift in the market. Unlike retail traders who chase short-term gains, institutions think long-term. They are accumulating XRP and RLUSD not for speculation, but to ensure smooth, reliable settlement for real-world transactions. This steady inflow of capital strengthens the ledger, reduces liquidity shortages, and positions XRP as the primary bridge for global commerce. In short, the RLUSD XRP system isn't just a technical upgrade, it's a complete revolution in payment infrastructure. It allows trillions of dollars to move efficiently, securely, and instantly. The system is designed to scale with demand, meaning as more banks and institutions join, the network becomes stronger, deeper, and more capable. This is why the price of XRP is not just speculation. It's a reflection of its underlying utility and the massive potential of the institutional pipelines it supports. Now that we understand how XRP moves money and works with RLUSD, let's talk about the part that confuses most people, the price and market cap. Many critics say that a $10,000 XRP is impossible because it would create a market cap higher than global GDP. But here's the catch. They are thinking about it the wrong way. Market cap isn't a physical limit on money. It's a reflection of price, not a barrier to it. Market cap is calculated by multiplying the total supply of XRP by its last traded price. This doesn't mean that all the money exists in XRP at that value. It simply shows the current price discovery. In other words, a high market cap doesn't mean trillions of dollars are sitting in the coin. It reflects the utility and volume the network can handle. If global institutions start using XRP to settle trillions of dollars daily, the price has to rise to accommodate that volume. The math isn't speculative, it's structural. Here's how it works in practice. Suppose banks and institutions need to move $30 trillion a day across borders. XRP's price must be high enough to allow those large trades without creating massive market disruptions. If the price is too low, moving a large sum would crash the ledger and create huge slippage. High price equals high liquidity, which means large transactions can happen smoothly. This is bridge math in action. Price is determined by the real-world utility of the network. Critics often get confused because they see price and market cap as limits, but the truth is the opposite. The price sets the market cap, not the other way around. As XRP's network utility grows and more capital flows through its ledger, demand increases naturally. This drives up the price, which then deepens liquidity, allowing even bigger trades. It's a virtuous cycle. The higher the price, the more efficient the network becomes, and the more institutions want to use it. We can also see this logic in action with stablecoins like RLUSD. By providing a stable point for capital to wait, the network ensures that price volatility doesn't disrupt massive institutional transfers. XRP handles the real-time settlement, and RLUSD provides stability. Together, they create a system where price is aligned with actual usage, not speculation. This is why $10,000 XRP is not just a wild prediction. It's a functional requirement for a network that can handle global commerce at scale. Another key factor is supply-side pressure. XRP is deflationary because every transaction burns a small fraction of tokens. It might seem negligible for small trades, but when billions of dollars are moving daily, the cumulative burn becomes significant. This reduces supply while demand grows, creating a natural upward pressure on price. Unlike traditional assets where scarcity has to be manufactured, XRP's network mechanics create it automatically as utility increases. Institutional accumulation is also playing a major role. While retail investors may panic during market dips, institutions are steadily absorbing millions of XRP. This reduces circulating supply on exchanges, creating scarcity while the network handles real-world settlement. These paper losses that companies report are simply the cost of conviction. They know that the long-term infrastructure and utility will outweigh short-term price swings. In simple terms, the $10,000 target isn't a hype number. It's the mathematical outcome of a fully utilized bridge. The current volatility isn't a sign of failure, it's the noise of a transition from a retail-driven market to an institutional infrastructure market. The ledger is maturing, liquidity is deepening, and the math is clear. High utility requires a high price. Now that we understand XRP's price mechanics, it's time to explore the structural factors that are quietly driving long-term value: institutional accumulation, supply shocks, and the deflationary burn mechanism. These are the forces that set XRP apart from almost every other cryptocurrency. First, let's talk about institutional accumulation. Unlike retail investors who often panic during dips, large institutions are steadily buying and holding XRP. In early 2026, we've seen smart money absorb hundreds of millions of tokens during price drops. Even while retail sentiment is extremely fearful, these institutional holders aren't looking for quick profits. They are positioning for long-term utility. By locking up XRP in their portfolios, they reduce the circulating supply, making the token scarcer and more valuable over time. Next comes the supply shock. Exchange reserves of XRP are plummeting to levels we haven't seen since 2018. Massive institutions don't buy through retail apps. They directly access liquidity pools, ETFs, or private agreements. This drains the supply from public exchanges, creating a physical scarcity that reinforces the asset's value. The more tokens are locked away in institutional vaults or tied to long-term settlement systems, the less is available for daily trading, which naturally pushes the price upward when demand increases. Now, let's add another layer: the XRP burn mechanism. Every transaction on the XRP ledger destroys a tiny fraction of XRP. While this might seem trivial for small transfers, consider the scale of institutional adoption. With daily settlement volumes potentially in the trillions of dollars, the cumulative burn rate becomes significant. Over time, this reduces the total supply of XRP, creating a natural deflationary effect. The combination of high demand, reduced circulating supply, and ongoing burn pressure is a powerful structural driver for long-term price appreciation. These three factors, accumulation, supply shock, and burning, are interconnected. Institutions move in, locking up tokens and reducing exchange liquidity. This creates scarcity. Transactions on the network then burn a portion of those tokens, further tightening supply. With a growing global demand for a fast, reliable settlement network, XRP's value is structurally supported. This is why short-term price swings are not always reflective of the network's underlying utility. Let's put it into perspective. Imagine a central bank needing to transfer $50 billion at a low XRP price. Moving such a huge sum would create chaos, with every trade pushing the price up uncontrollably. But with a higher XRP valuation, the network can absorb these transactions smoothly. This is where the $10,000 price target starts to make sense. It's not a speculative guess. It's the functional requirement for XRP to handle institutional scale transfers without disruption. Another point is the controlled release of XRP from escrow. In the past, monthly token releases added uncertainty to the market. Today, these releases are managed carefully, often routed directly to institutional partners or payment corridors rather than hitting the open market. This reduces the flood of new tokens, preserves scarcity, and aligns with the ledger's real-world utility. The system is now designed to tighten the supply as adoption grows. Finally, we have to consider how all this ties into long-term infrastructure adoption. XRP isn't just a coin for traders, it's a settlement layer for the global financial system. As more banks, ETFs, and payment providers integrate XRP, the combined effect of accumulation, supply shock, and burn ensures that the network can scale safely. Short-term volatility may continue, but the structural factors are creating a foundation for sustained growth and a systemic re-rating. As we reach the final part of our breakdown, it's time to look at the big picture, how XRP is positioned to become the backbone of global finance in the coming years. We've already discussed liquidity, stablecoins like RLUSD, institutional accumulation, supply shocks, and the burn mechanism. Now let's connect the dots and understand what this means for the systemic migration of the world's money. First, the migration from legacy banking systems to XRP is already underway. Banks and financial institutions are slowly moving away from slow, pre-funded settlement methods toward real-time digital infrastructure. This isn't just about faster payments, it's about transforming the way trillions of dollars flow daily. XRP's ledger can handle massive daily volumes without disruption, making it the perfect candidate for a global settlement layer. The more institutions adopt XRP, the stronger the network becomes, and the more efficiently the global economy operates. Next, regulatory milestones are key to mainstream adoption. Laws like the Clarity Act and frameworks established in 2025-2026 provide a legal foundation for banks and ETFs to integrate XRP safely. Without these milestones, large financial players would hesitate to commit billions of dollars. But with regulatory clarity, institutions can confidently use XRP for cross-border settlements, stablecoin integration, and high-volume transfers. This is why legal and legislative developments are just as important as technical capabilities. They pave the way for mass adoption. We also need to consider the role of ETFs and institutional products. Spot XRP ETFs launched in late 2025, bringing in over $1 billion in a single month. These funds insulate large capital from short-term retail fear and create a structural engine for demand. Institutional investors now view XRP as a permanent portfolio allocation, not a speculative gamble. This is a fundamental shift from a hype-driven market to a utility-driven market. Looking at the adoption roadmap, several critical events are shaping XRP's trajectory. March 1st, regulatory deadlines, activation of new protocols like XLS66, and potential entries from major players like BlackRock into XRP-based products. Each milestone strengthens the network, improves liquidity, and ensures that XRP can function as the plumbing for global commerce. The roadmap shows that adoption isn't random, it's structured, predictable, and guided by real-world utility. The systemic shift also highlights the contrast between retail fear and institutional conviction. While retail investors panic over short-term volatility, institutions are quietly building the foundation for massive capital flows. Exchange liquidity is shrinking as more tokens are locked in vaults or routed through institutional channels, creating scarcity. Combined with the burn mechanism, this establishes a supply-demand imbalance that supports long-term value growth. So what does this mean for the future? XRP is no longer just a speculative asset, it's becoming a global financial primitive. The price will eventually reflect the utility required to handle trillions in daily transfers. $10,000 per XRP is not a moonshot. It's a functional necessity for a system that moves the world's money efficiently. The math, adoption trends, and network mechanics all point to a network designed to scale with the global economy. In conclusion, the story of XRP is a story of transformation, from idle capital trapped in outdated banking systems to a fast, scalable, and reliable global settlement network. We've seen how liquidity gaps are closing, institutions are accumulating, supply is shrinking, and the ledger burns tokens to maintain efficiency. Regulatory clarity and adoption roadmaps provide the final layer needed for systemic migration. For viewers, this means understanding XRP isn't just about chasing price pumps, it's about seeing the network as a long-term infrastructure play. If you position yourself with knowledge, patience, and awareness of real-world adoption, you can navigate the transition from a retail-focused market to a utility-driven global financial system. That wraps up our 6-part breakdown. If you want to stay ahead of these moves, join our free Discord, link in description, explore our crypto safety courses, and use our recommended exchanges to stay liquid in extreme market conditions. XRP is no longer just a cryptocurrency. It's the plumbing of the 21st century financial system, and the bridge is being built right before our eyes. Thanks for watching. We are Cosmic. If you found this breakdown useful, like, subscribe, and hit the bell so you won't miss the next deep dive into crypto and finance. Until next time, keep learning, stay curious, and watch the bridge transform the world of money.